Now, yesterday, the Reserve Bank of India successfully concluded a $5 billion long-term USD INR swap. It infused about 35,000 crore in liquidity into the Indian markets. Now, many interpretations into why the RBI went down this route and what it implies for future policy. Joining us to talk about that and the broader money markets is Jayesh Mehta, Managing Director and Country Treasurer at Bank of America-Merrill Lynch. Good afternoon, sir. Thanks for joining us here. I was joking with someone that there are as many interpretations of this swap plan in the market as there are banks, but I'll give you the final word into why you think the RBI went down this route and what it signals.
So I think there are three things which happens together with this one. A, of course, is when you do OMO purchases of government bonds, it's again your asset liability allocation. So it's how much is the asset you want on the rupee side and how much is the international asset you want. So that is the larger question. So that's one. And secondly, of course, this could have been done in a situation only when you have flows coming in. So this really helped, and of course it also gives you a chunkier one, because if you do open market operations, you do maybe 12,500 crores, maybe 14,000 crores, 15,000 crores a week. It really takes time. Whereas this one was a test one, $5 billion. You put in 35,000 crores in a single day, right? So that's something really helps. I think it was always there as a tool. But yeah, doing this as a by way of auction, that's the first time they have done it, which is much better and transparent, and it infuses liquidity in a day. So I think that's a better way to do it. So maybe with this being successful, I'm quite hopeful they will use this in future too.
Jayesh, hi, this is Harsha. So does this, in a sense, fulfill the need of liquidity in the near term? What is your assessment of liquidity for now, and the scope and need for OMOs here on? Is that reduced as well?
No, so definitely now it's a question of what do you think is the adequate liquidity, right? Like somebody like me, old school thought, still believes that when your inflation is in control and you're looking at growth, you should be at a surplus liquidity of 60 to 70,000 crores, right? But I think nowadays there is a theory like, liquidity has to be negative. So, you play between 50,000 crores negative to maybe 2 lakh crores negative, but it has to be negative, which I don't personally agree. I believe on both sides you should have 75-80,000 crores plus or minus, depending on the stance. If it is hardening stance, then the liquidity has to be short by 70-80,000 crores. If it is softening stance and accommodative stance, then it has to be 70-80,000 crores surplus. But so that's the debate. One has to really go into larger thing. But if you are looking at system liquidity after this, maybe it would be negative still 30-35,000 crores. But as the election comes, currency, and as your growth comes in, the normal liquidity infusion requirement is much larger. So we would say there would be another at least 2 lakh crore liquidity requirement for FY 19-20 minimum.
But Mr. Mehta, that would be...
at this juncture, particularly for April, May, we should be fine.
Yeah, I was going to ask that liquidity requirement will only come through in the second half of the year, right? As the new financial year starts, you will see some natural liquidity flow, some of the tax money come back. So there is no near-term OMO option now from April, would you say?
Yeah. In fact, April, May, we don't really expect any OMO options coming soon. Even if, and now of course, it's not necessarily liquidity. They will use only OMO. They could also use this swap window, which has been successful. So maybe once we may see something in June, it could be a swap window, it could be OMO, and then again, similar to last year's pattern. But I would say last year we actually delayed it a lot. Maybe we should start building it. Of course, we'll have to see how the growth pans out and the currency in circulation grows, right? So these two are also very crucial for currency for liquidity management.
Mr. Mehta, I just want to segue into a broader issue related. We thought we'll get the first half borrowing calendar yesterday. We didn't get it. Maybe we'll get it later today. But what do you think is the capacity of the market to absorb borrowings at this stage? The gross borrowing number was quite large, as we all know, at 7 lakh crore. If they do what they had done, excluding last year, which is front load borrowings, what do you think the market response will be?
No, I think that's what they should be doing, right? I think last year they did try to do 50-50. I would say typically front load the borrowing, so you have definitely pressure because the issuance is there. But then at least kind of post September, October, the market kind of eases up a little bit, and that gives you a room for both the government as well as the market players to absorb the situation. So, and typically, as I said, like April, May, your liquidity is really good. Of course, there are a couple of challenges which we have because markets now used to OMOs, and of course, people have short memories. So, last 6 months we have been living on OMOs, and if OMOs don't come, traders are not going to like it. I personally think OMO or no OMO, basically, as long as you have liquidity surplus in the system, I think the rate transmission for softening bias happens. And that also brings appetite for bonds, that brings appetite for everything. So I personally think, I still believe that, you have softer rate, you need to have surplus liquidity. We have seen this earlier in Jan 15 to March 16, while we cut rates 4-5 times, your non-benchmark G-Sec yield was actually 10 basis points higher. That's because you didn't give liquidity. So I think liquidity is very important.
You're advocating a CRR cut, sir, basically without saying it.
In whatever form. Not CRR cut. You can do one more swap. You can do aggressive. It's like you don't need to wait till last. Right now, and now, it is not that much negative, right? So you can actually manage by maybe 2-3 OMOs, but you have to be in the market. You have to manage measuring it, and most importantly, firstly, you get the central bank needs to be convinced that it can be positive, and that's good, right? But as of right now, the feelers which we get is like, they want liquidity to be negative, at least 0.5% of NDTL. So that's where the dichotomy is.
One last word, Jayesh, and this is on the currency. Where do you see the currency, at least in the near term? We've seen significant amount of FI money coming in, at least in the last couple of weeks.
Yeah, FI, of course, money is also to link with swap because it does attract FPIs to actually buy with the swap being there. And of course, because the swap announcement, the secondary market also came off at least for 3 years. You had 3-year bond issuances. There is clearly, on a fully hedged basis, there was a gap of almost 2.25%. That was very, very attractive for FPIs. So that's definitely coming on the debt side. Equities, of course, I think we are more or less doing a catch up because when the world was receiving, the other emerging market was receiving money and flows, we had our border issues and things like that. And that's what we got catch up later on. So I think that month has been good. I think we also seeing a lot of FDI flows, right? So I think the flows wise, we are doing pretty well. Let's see if this momentum continues, then we should be back to normal. But at this moment, doesn't see why it should reverse it out. And globally, of course, US, the way it is, it definitely looks like EM should benefit out of it.
Mr. Mehta, I have a couple of more questions. Sorry, since we have you here, I'm taking the chance to ask you everything. So what is your assessment of the corporate bond side of the market? You're still hearing a lot of corporates complain about the fact that spreads are still very high. G-Secs may have eased, but their spreads have not eased. Do you find that worrisome? To me, isn't it just a reflection of, a credit shock that happened to the market? The market will take a while to bring spreads down. As risk aversion eases, it will happen.
Yeah, but I think we have come to conclusion that G-Secs also yield, right? So we have cut rate and G-Sec yield, if you look at old 10-year benchmark, is the same as where it was before the rate cut, right? And this was a surprise rate cut. A lot of people were not even expecting, and yet it is where it is, right? So it is also a liquidity factor, and I think it's the whole curve. So your G-Sec spread over the repo rate is also higher, and therefore once that spreads are wider, naturally your G-Sec spread, corporate spread over G-Sec is also higher. I think both these factors really matter. I think it's all coming back to liquidity. To an extent, in spite of having such a large buyback of bonds, you still are like an 125 basis point, 125 basis point higher than the overnight for 10 year. And even if you expect, like most of the people are expecting a rate cut in April, some are going to the extent of 50, but 25 is more or less built in. Even with that, 7.5 old year, 10 year benchmark is high. And based on top of it, you have, corporates maybe at around anywhere between 830 to 850 before the swap announcement. Post the swap announcement, it has come off by almost like 20-30 basis points.
Okay, so you see that also as a consequence of liquidity mostly. Last question, Mr. Mehta, and this is on that voluntary retention scheme of the RBI. They've managed to get about $1 billion, I think 65 or so, 6,500 crore I saw on the corporate side last when I checked. What is the response on that according to your view, sir?
So I think that is going to take time, right? It's a great scheme because, if you really look at it, our whole FPI thing was kind of half-hearted because always we believed that brings hot money. And we were kind of vindicated last year when you had $12 billion outflow in a matter of 20 days. We saw that even in 2013. Now, with this kind of situation, I think the central bank would be more comfortable to do a VRR, but as long as these old limits are available, naturally people will use VRR as an option. So maybe right now not go away on the VRR side in a hurry, but as and when the old limits get filled up, I think people will move dramatically to the VRR. And I think once we move to the VRR, central bank will be more open to open that limit larger, because at least that's like your ECB, right? At least you know the 3-year cash flow. So from that perspective, they would be more comfortable and they would open it up much larger than the 5% outstanding.